Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Jobs Week, what we've seen so far, what to look for in Friday's jobs report, and what the Fed could do in response. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah. It's Jobs Week, and we've had a lot of drama this week. It's Thursday morning, and a lot to talk about. By the time this podcast comes out, Jobs Report Friday will be here. But whoa, a lot has gone on. You know what? We need to have, I know you're never going to have Logan 24/7, 7 days a week, okay? But we should really make this 4 days a week, and then you could have, your one guest come on one of the days, but just have me 4 days a week. I would ask for 5, but I know you would never, give me that wish. But 4 days a week, I think the audience would love.
It's nothing personal. It's just there's a lot of news that goes on. So, 3 days a week right now works. But let's get to, it is Jobs Week. Catch us up on what's happened already with the jobs data we've gotten and where you think we're going to end up on Friday morning.
Okay, so as of this morning, jobless claims did come out. Headline claims perked up a little bit. Continuing claims fell. So 4-week moving average, 300, we're nowhere close to the 323,000 level that, that would really start pushing red flags. But the 4-week moving average is at 236,000. So we're creeping up a little bit higher, but nothing too bad. However, the ADP report that nobody really cares about, sometimes it has a really big number, sometimes it has a really bad number. It's just like every single year. Jobs reports have 2 to 3 reports that are really bad. And, people sometimes, not sometimes, all the time, so always overreact to it. But in this case, man, the 10-year yield right away, bam, negative. Then on top of that, yesterday, the ISM number, new orders near cycle lows. Okay, prices paid, perking up a little. So that's another hit to the 10-year yield. And then we got back down to the 435 level again, Sarah. Here we are. So for those that don't know, 2 months ago, April 4th, the jobs report came out. The jobs week came out that week perfectly fine. There was nothing wrong with any of that, except the 10-year yield's at 4%, right? The trade war, people were going straight into the recession. The trade war is 100% recession. We had literal people just say 100% recession for sure. So bond yields went down. I was like, and I've always kept this tweet because I said, these levels are really critical for me. If there wasn't a trade war, Godzilla tariffs, we would be at 435, not at 4%. So 435 is for me this year is key in terms of 435 to 470 is the upper range for my forecast. If the economy's progressing forward, fine. That's an acceptable range. It doesn't look anything off to me. When we start going lower than 435, and then, if it ever hits the Hoardor line, again, Hoardor line is 380, the market is really pressing weakness, right? The bond market is saying, hey, listen, the Fed is behind the curve. So a lot of people keep on saying, well, if the Fed cut rates like last time, mortgage rates went up. No, that's not how it works. The 10-year yield got way ahead of the Fed, right? And it was pricing in a recession at that point, and it didn't happen, so yields went up. And where we are right now, I think as of this second, I think it's 437. It looks right. But if Jobs Friday has a miss, like we saw at ADP, if it comes in at like 30,000, oh Lord, someone's going to be tweeting out, cut rates, too old, too slow. No, I can't say that. That's Logan's line. You're too late. Come on. So right after the ADP report, man, Trump came out, Pulte came out, calling for lower rates, so you see the game plan here. As my old high school basketball coach said, you play the refs. They're really trying to play the refs here because if the labor market breaks, they're going to say, hey, listen, we said so. They didn't cut rates, trying to get ahead of the curve or play the ref out there. So at least you have something saying they should have done this. So that's clearly going to be the case with any real weak economic report going out.
So I know that these are different reports. They measure different things. Does anything we've seen this week give you a hint about what we will see in tomorrow's jobs report in that specific one?
So the job openings report, okay, so job openings perked up a little bit, the headline number. The internals of the report in terms of how many people are unemployed and how many job openings are pre-COVID levels. So the Fed got what it wanted, attack the labor supply to get job openings down to that place. So what's happening is now we're still waiting to see what the impacts of Doge are. Oh my God, was it like 9 billion? By the way, has anybody seen Musk and Trump fight with each other now? Yeah, it
Oh,
reminds
they
me
are
of
fighting
what
today.
was that movie? Pedro, Napoleon Dynamite, where they're like, slap fighting on each other. Now they're doing it on social media today. See, Musk feels betrayed because he doesn't get his EVC, his tax cuts for his cars or tax credits, and now he's trying to cause some drama. In any case, states were doing a lot of the government firing. The jobless claims data for the federal workers spiked up, and now it's coming back down to pre-Doge levels, almost there, not quite there. So we're trying to see that if the labor market is stable, then does the total number fall from any of these things recently? So for me personally, what have we've always taught people economic cycle work. We want people to be educated in this. Residential construction workers is key, right? 2 of the 4 reports this year. By the way, I mentioned this and not a lot of people knew this. So I'm not doing a good enough job talking about this, but 2 out of the 4 residential construction labor reports were negative this year. If it happens tomorrow, that'll be the first back-to-back negative reports we have. And the reason I show this is I show people economic cycle work in the last few cycles. It's not the inverted yield curve that's giving you the recession. It's an inverted yield curve plus residential construction workers losing their jobs, which then tags the jobless claims data to a certain level to where you really start to talk about a recession. So now we have a legitimate a model here that's working. So you want to keep an eye on the residential construction workers tomorrow to see if that has another negative report. That'd be the first time. And the reason we really stress this is December 23rd, 2024, we said, who's in stress? Home builders, right? And we'll get into the home builders a little bit later on the crazy data lines they have. But it's a supply and margin problem. And now it's not like really jobs created. We have negative prints now in the report. So you want to keep an eye on that. Keep an eye on the headline number as well.
Okay, so and why are residential construction workers so key? Because there's so many of them, or because it's an early bellwether of like if people aren't building, like why is it?
So whenever the Fed raises rates to a level that they want to be restrictive, the capital portions of our economy, the sectors that need rates to be high or low to really grow, start to get hit. So that's typically residential construction workers and then manufacturing as well. So people always like to look at residential and manufacturing. Last year, manufacturing jobs were lost actually, but residential construction workers has a better thing because we're a consumption-based economy. So at that point, we keep an eye on that. Not a lot of people knew this. Like once they look at the chart, they're like, whoa, it's just like, Bill and Ted adventure. Whoa, man. But in this case, you're starting to actually see some weakness. We'll go into that a little bit later. But now we're starting to see, is the trade war really doing things? Trucking industry, other parts of the economy, travel, maybe domestic travel is gone good. International travel, not so much. So we're keeping an eye on it because hypothetical, let's just say residential construction workers had 7 straight months of job losses. Guess where that's going to go? That's going to go to jobless claims. You go, bam, down, 1 goes up, right? So you got residential construction workers going here, jobless claims go up here, and that's how economic cycles work, called the X, and then there it is. So that's why we always try to tell people after November 9th, 2022, permits started to rise again. Residential construction workers don't usually lose their jobs. So be careful of going into the recession call until this happens. And now here we are, June of 2025, and it still hasn't happened yet because the labor, and this is so pathetically boring because it's a progression model. It's not very exciting to do this. Progression models do not ever end really. They just kind of go into recessions out. But here you are, it prevents you from being way too early on your recession calls. So this is why we want to keep an eye on the residential construction worker side.
Okay, so Powell has talked about that it's labor over inflation, right? Your whole thing for the last 2 years has been labor over inflation. The Fed, Powell and other people have talked about that's exactly right. How responsive do you think he's going to be if we see a miss tomorrow?
Okay, so what did they do last year? The Fed, old and slow, right? We always said they're going to hold financial conditions as tight as possible until the labor market starts to, crack on them. So Jerome Powell admitted finally, I'm still surprised he even said this, that, by the way, we were a little bit late last year because,
Right.
Logan was right about us. He said we were going to be as
He didn't
restrictive as
say
possible
Logan.
until the labor market. I know, but in any case, he said, yeah, we held it. We held. So this is why you had a 50 basis point cut last year and then 2 quarters, because you have to realize the Fed looks at it this way. The Fed funds rate here, wage growth is here, inflation is here. So they will tell you they are modestly restrictive. This is after the eggnogs, spiking of the eggnog. Before the eggnog, that Powell was ready to play. He said we would like the Fed funds rate to mirror 3, 6, 12-month inflation. This means, oh my God, here we are, 3% Fed funds rate, 1.5% rate cuts already. We got lower mortgage rates. That works. But whoever did this, the Grinch, Garfield, Pee Wee Herman, somebody spiked the eggnog and everything changed. And I was like, whoa, my God, I have to change my whole outlook now, because it took a while for people to pick it up. It's funny. It's like now people are starting to realize, oh, that whole thing was right. You weren't kidding back in the end of 22.
And that was
They changed everything.
2023.
No,
2022.
2022. It was toward the end of 2022. I still remember the Powell presser when he was saying we would like to mirror, and then they changed everything. So in any case, of course, President Trump wants lower rates. Pulte wants lower rates. The Treasury wants lower rates. The question going out is, how fast is the Federal Reserve's response if, let's say, we have a report 60,000 and then the next month is 70,000? So then we go into another aspect. I know this is very nerdy. I apologize for everyone, but we always say, if the labor force is not growing, the unemployment rate could stay lower than what people have talked about. So we went from 3.4% unemployment rate to 4.2, and no jobs lost because the labor force grew, right? Immigration, a lot of people were looking for more work. That has stopped, right? So the break evens of keeping, jobs at bay was like 160,000 last year. Jed Klecko, who used to be the economist for the White House, came out today. It's like, it's 50,000 because there's no economy in the world has a Dorian Gray labor market. So people age and then they die. And then you have less immigration. There's less people looking for work. Even if jobs numbers start to come down, the unemployment rate might not go as high as some people think. So this is something that we have to keep an eye on, because it's finally, we're seeing, there's less migration into the US. The baby boomers cannot stay at the same age. Was it Logan's Run we always talk about?
Yes.
And again, the book was brutal. They were like killing people at 21. The movie was at least like somewhat respectable. You had
30,
33,
right?
and there was like some old baby boomer at the end of the movie. They're like, oh my God, look, it's a baby boomer there. He probably owns 50 houses, So in this case, that's something to think about going out in the future, is the unemployment rate going to be lower than what people think? Now, if the unemployment rate starts to perk up, boy, that's even more detrimental for the Fed. So you can look at it in that sense. Now the Federal Reserve is probably thinking, all right, if the unemployment rate's really kicking up, that's really bad because the labor force growth has slowed down. And I think one of the Fed presidents even talked about that today. But to me, it's, if job growth is trending below 133,000, that's the low point. That's a net negative. You got to wonder, at what point does the Federal Reserve start the leaking out that we're going to be a little bit more mindful? Because the hirings aren't that great, right? And even the Fed says, if you're looking for a job, it's not the best environment, but we're not laying off people, right? And again, every month, 1.5 to 2 million people get laid off. Jobless claims never goes to zero. People, get fired all the time. But when growth starts to slow down, then the need for labor starts to come down. There's where we see recessionary data post World War II, right? Consumption slows down, growth slows down. You don't need as much. People aren't spending as much out here. So it gets a little bit more interesting on that. That's a little bit more technical, nerdy on labor force growth. But we brought this up a lot going into this year, how got to be a little bit mindful on the unemployment rate, because if the labor force was growing, then the unemployment rate can go up higher. But the Fed might say, okay, listen, the labor force is higher. So there's all these variables in here, and this is why nobody cares about economics. Y'all want straight, simple answers. It's like Sarah always asking, when are rates coming down? I say this has to, that has to happen, this has to happen. But man, it's really exciting. This has been a really exciting year. If you're a total nerdy, geeky person like myself, this has been fun.
Well, if you're also a news person like myself, it has been very fun. So, I mean, there's so much going on. So, from your perspective, there are those triggers that that would probably mean something to Powell. And I would think that, I mean, he's a person. You talk about playing the refs. He's been really clear that he's going to hold steady, but he's also been clear that like they were too slow. So it feels like if they get something, they might react.
Let's just put it this way. It's very known that if residential construction workers start losing their jobs and they sit there and they look at that and they tend to ignore it now, with all the data that we have had since the Peloponnesian War, that's no longer acceptable.
Yeah.
Right. It's no longer acceptable for them to just do their standard. Well, the economies, they keep on saying the same thing through every cycle. And then they go, oh my God, a recession happened. How did we miss this one? Sarah Wheeler, how did we miss this one? Well, the data was right there telling you something. Oh, I don't know. The current data, the lag, so now it's like everyone's kind of pushing. But that's why I say we have 2 of the 4 residential construction reports were negative. Nothing spectacular, but they were negative. We're not growing anything. Permits are in recession. So it goes into now the builders, the most unbelievably crazy data line, the purchase application data, not only just for existing homes, but for the builders and the new home sales sector, which is really puzzling everyone this year more than even I thought.
Okay, so let's talk about that. So we have purchase apps for the existing home sale market, and then the builders. There's for the new home market. They have their own separate data line. So tell us what we see in both of those things.
Yeah, I mean, if it kills me, I'm going to get everybody to realize, stop looking at the existing home sales market, purchase that, and say the builders. The builders are at 2019 home sales. That's like 1 million more for the existing home sales market. So in this very, very crazy world that we live in, and I say this because, this was our wild card area before Christmas. We said, keep an eye on here, but supply and margin story, right? So what's occurring is the new home sales sector just hit a multi-year high in sales, but their purchase application data is at post-COVID highs, post and pre-COVID highs. And you're looking at that thinking, wait a second. Yeah. But then you look at the builder stocks, they're not doing well. Permits are at recession levels, starts at recession levels. What's going on here? Well, there's the big publicly traded builders that have a very good balance sheets, showing people the corporate profit margins, right? Operational margins and gross margins, and say builders can still have wiggle room, and they'll just pay down rates and sell products and manage. But there, when you look at the amount of homes that haven't started yet for sale, if you look at them, it's at an all-time high. It's like 119,000. The amount of homes that are completed for sales, 117,000. It's not happen. This is so funky, but this is the truth. So they're sitting there thinking, okay, we're just going to get these homes sold because we sell homes like a commodity, right? The existing home sales market, which is sitting on $35 trillion worth of nested equity, they can do stuff like that if they want to, but that's a whole different ballgame. We don't even, that's totally different. But the builders are just kind of pushing sales through, and sales really haven't gone anywhere for years. But in the last report, which will probably get revised lower, it's very true. Multi-year high in sales, post-COVID high in purchase application data, right? Millions of people buy homes every year. We're going to have near 5 million total home sales again this year. But here, but now the builders are discounting, they're cutting prices. They just need to move product, right? There's no construction building going on right now. No permits are going to happen. Why? Why, Sarah? Why won't the builders
Because
do this?
they're not the March of Dimes. They're here
They're
to make
not
money.
the March of Dimes. They are here to make money. And everyone said in 2021, we're going to have the biggest construction boom ever. And I was like, oh, man, you've never run a business, have you? No. As soon as rates went up, done. So that's it really has confused people, but that's the best way I could explain it, is that they're just kind of managing their sales. And in this environment, unless rates go lower, they're not really vested into issuing permits or anything like that. Apartment construction, of course, those units are coming online.
Yep.
There's places where there's where rent is starting to pick up again. That would be the area you would probably want to maybe start permitting or investing in. But other places, there's just a lot. So, in this sense, it's a very confusing data line. It's tied to my economic cycle, so I have to follow it religiously. But a lot of people are just confused about the new homes sales purchase application data and sales being high, but then permits are at recessionary levels, starts are at recessionary level. The builder's confidence is near COVID-19 lows, and that's tilted more for the smaller builders. So that's why we want to keep an eye on that tomorrow, or today. Keep an eye on that residential construction job. See where that's at right now.
Mike Simonson talks about data instead of vibes, right? Like, we don't want vibes, we want data. And the purchase application data, to me, really illustrates this, because the vibe that many people have about the housing market, understandably within a lot of chaos, elevated rates compared to the recent past, is that, it's been a really terrible year for the housing market. But the purchase application data says something else. Now, not like, wow, it's been gangbusters, but hasn't it been like 17 weeks, 18 weeks of positive purchase application data?
It is the craziest thing this year. The most unloved story and the most unbelievable story is that purchase application data. If you didn't know what was going on and somebody told you that we have had 18 straight weeks of positive year-over-year growth, we've had 5 straight weeks of double-digit year-over-year growth, and you're thinking, whoa, okay, housing fine. And again, we've always said this is a funky survey.
Right.
And one of the reasons why I always try to stress this is the lowest levels of sales ever adjusted to, like, people, I cannot stress enough how low home sales are compared to the workforce and everything. It doesn't take much to move the needle. So obviously people want an explanation for this, because they're always taught that if purchase application data is growing, sales would be growing. And just remember that even if existing home sales stay flat for the rest of the year, does not even move 1 ounce, just stays flat, the reports in July to November for the months of June and October all will have positive year-over-year growth data. How the existing home sales track is a little bit different. How we track our pending sales from Redfins or Realtor.com, whatever, how everyone tracks their sales different. But if you look at how the sales trends are going, we could have flat reports and have like 5-6 months of positive year-over-year data. And people are like, okay, what's happening now? It's a very low bar. I would say this: the weekly data, it's like 10 positive, 8 negatives, 3 flats. That hasn't been as positive, but because we're working from such a low bar, this is something everyone should think about. One of the reasons why I want more inventory and more new listings back to normal, because remember, 70 to 80% of home sellers are buyers. That home buyer who's selling his house has filled out a mortgage purchase application data, because once he is there, he's going to, sell the house and know how much he is approved to buy another one. Because new listings data has finally got to a level where it's somewhat normal, right? 80 to 110,000 would be normal pre-COVID. We got a little bit above 80. That in a normal setting would mean you have the ability to grow purchase application data on a year-over-year basis. And because the days on market are not as low as they used to be, it can take some time before it filtrates itself into the data. So I had to give an example. I said, guys, do you guys remember what happened late 2022? They go, what? Of course not. You don't, but I do. November 9th, whatever, 2022, 10-year yield. We talked about that October 27th. The next move in 10-year yield is going to be lower. So we need to see if the forward-looking data gets better. 10-year yield started to go lower. Purchase application data had 12 weeks of positive data. Wasn't hitting the sales report. Everybody's like, oh, purchase apps is getting better, but it's not hitting the sales report. I said, wait for it. 30 to 90 days, right? We always say purchase apps look out 30 to 90 days out for sales. We had one of the biggest month-to-month sales prints in the history of America. It's like almost 500,000 home sales in one. That's crazy. But
That was in
sometimes they,
2023, like after those
no,
things hit the press.
just that first month, in 2020, it all filtered into one report. And sometimes this happens with existing home sales, right? Sometimes it spreads itself out. Sometimes it went in, and that I remember saying, "Oh, that's the peak of sales." By the way, we're not growing anything above there. Okay, there it is, right? After that, home sales started to trend lower. The end of 2023, we had 8 weeks of positive data. That isn't enough. I need at least 12 to 14 to get something going. Here, we had 2 months of growing sales, but after the second one, purchase application data was going negative. I said, that's it. Sales have peaked for 2024. That held up. But here, purchase application data is growing on a year-over-year basis. New listings data is growing. So just think of it as an extremely low bar. And last year, rates went up for the first part of the year. This year, rates kind of went down. All right. So you get a little bit of growth from new listings, a little bit. There you go. You get a little bit of kick. And because of that, if home sales, even if they don't grow month to month for the rest of the year, they stay flat, you're going to have a few 5-6 months of possibly year-over-year growth. That's kind of the technical way to kind of look at this out here. And just remember, apps 30 to 90 days out. If it takes longer to sell a home, it might even take longer to get in that. And that's how housing is, right? Mortgage buyers, first-time home buyers buy a house from a move up, move down buyer. That person then goes, buys another house. So you get those transactions flowing out here. And this is why it's a little bit surprising to me that, with elevated rates, this is happening. But those people that are listing their homes, they're filling out an application as well. So year-over-year growth in new listings, year-over-year growth in purchase application data, kind of look at it that. Sales have pretty much been the same for a few years now. But if mortgage rates had gone to 6% and stayed there, then we have something going.
Amazing. Well, we are almost out of time, but I did want to give you time just to say this. When you track purchase application data, you feel like now we're at the seasonal point where you wouldn't expect it to continue to go higher, right?
I always counted this data line or give it weighting from the second week of January to the first week of May. And after May, total volumes tend to fall. This doesn't mean that if mortgage rates went down 1% for the rest of the year, that data line wouldn't get better and it wouldn't improve. Here, another great example, last year, rates went down to 6%. We had 18 weeks of positive forward-looking purchase application data. No year-over-year growth, not once during that period of time, except it gave us a couple 100,000 more home sales, right? So it's a funky survey. Just follow the tracker and then you'll understand, kind of where it's going, because we're months ahead of everyone else. So we get to see things before it comes into the traditional data lines. So right now, it's just now our pending sales data is positive in this context. So it's just because the bar is low, and the bar is really going to be low for the second half of 2025.
I'm a big fan of the tracker. I remember when you're like, no, we're starting this because you had all that data. Every Friday night, that's what you're doing, Saturday morning. And I think the result is really valuable for our audience. So love the tracker. Everybody check that out. And Logan, we will see you in just a few days in person at the gathering.
Yes, we got one more podcast before, but definitely that presentation I'm going to do is going to be a little bit different than the other presentations I usually give. It's going to be a straight raw, what the hell is going on right at this second, because there's so much stuff, especially with the president, the Fed, and everything, and jobs data. And hopefully everybody gets to know why we did paper, rock, scissors, labor over inflation. Boom. That's the reason. Because if you look at the growth rate of inflation, PCE headline is 2.1%, but we're still here because Fed policy is still here. And by the way, what happened? The debt downgrade, the bond market is afraid of deficits, the tax bill and everything, and the 10-year yield is lower now. And that's how it works as the Polypedia more. So be careful of like the media debt fear talks. If the bond market really cared, 10-year yields north of 6, 7, 8% today. Not happening.
Not happening. Logan, thank you so much as always, and we will talk again soon.
Pleasure, Sarah Wheeler.